In this video, I'm going to cover the gross profit effects of choosing different inventory cost flow methods, and I'm using an alternate version of exercise 5.4 as an example. Now, previously in our last problem and video, we were given the setup of this problem where we had beginning inventory and two purchases, and cost was actually falling. We started with purchases at $7. It shrunk to $6.80, and then our most recent purchase on January the 30th was $5.90. Keep in mind our selling price, that's the cost to us. Our selling price stayed consistent at $18. We previously already calculated with the 4 different inventory cost flow methods what cost of goods sold is in ending inventory. And what we want to do is do a comparison of cost of goods sold and also calculate gross profit and make a comparison of those different cost flow methods, again, in a situation where cost is falling like it is here. So I'm going to calculate gross profit under all of these scenarios. The one thing that stays standard, cost didn't stay static, it changed. But the one thing that stays the same between all those methods is sales. The cost flow method has no impact on the selling price. It stayed consistent at $18. So the sales value in total, irrespective of which method is chosen, is $4,680. But again, with changing cost, we are going to have differences in cost of goods sold, and therefore we'll have differences in gross profit between the different methods. So the prior video goes into detail. I'm just going to quickly do a review here. Specific identification, we had to be told either what units were in ending inventory or what specific units that we sold. For example, we were told that 20 of the beginning inventory units, 20 of those 200 units was in ending inventory. So therefore, we must have sold 180 of them at $7 each. We totaled up that under specific identification, cost of goods sold was $1,804. Pulling this down into the first part of our multi-step income statement, cost of goods sold under specific identification is $1,804 minus the sales value of $4,680 gives us a gross profit of $2,876. We next went to weighted average. Weighted average simply totaled up all cost, divided it by the total number of units available. It got an average cost per unit of about $6.60, multiplied it times the total number of units sold, and we got a cost of goods sold, if we round it to the nearest whole number, of about $1,715. $1,715 cost of goods sold for weighted average minus sales of $4,680 gives us a gross profit of $2,965. FIFO is first in, first out. So the pattern here is when we were costing out the units, we started with the earliest purchases first. What was left was our most recent purchases. Cost of goods sold under FIFO was $1,808 minus our sales value of $4,680 gives us a gross profit under FIFO of $2,872. Our last cost flow method was LIFO, last in, first out. Opposite the pattern of FIFO, we assume that our most recent purchases, which would have been January 30th, are the ones that we sell first. That's our assumption. So we're going backwards when we do our cost of goods sold, and we're costing out our most recent purchases first. Cost of goods sold under LIFO was $1,624 minus sales of $4,680. So gross profit under LIFO would be $3,056. Now I'm just clearing some space here so you can see the comparison between cost of goods sold, sales, and gross profit of all these methods. Again, no impact on sales with our cost flow method, but since cost does not stay the same. Had cost stayed the same, if it had been $7 consistently all the way through on all the purchases, cost of goods sold and gross profit would be exactly the same between the different methods. They're using all the same cost. But costs fell in this scenario. And what we can see is a pattern that forms in this situation. Now, I will say specific identification doesn't necessarily follow a pattern because you are tracking specifically which units were sold. But there is a set pattern between weighted average, FIFO, and LIFO when you have a situation where cost is falling like it is here. And what we can say when we compare the numbers is weighted average creates a cost of goods sold and a gross profit somewhere in between FIFO and LIFO. And that will always be true because it's averaging out the change in the cost over time. We can also say, like we see here, that when we use FIFO and costs are falling, that our cost of goods sold is going to be the highest and our gross profit is going to be the lowest. That's a pattern we can say here. LIFO, our cost of goods sold under falling costs, is going to be the lowest, and therefore we flip that around because our lowest cost of goods sold subtracts from the same sales, and our gross profit is going to be the highest. That's the pattern that we can say. Now, that's a set pattern if costs are falling. It's opposite if costs are rising, and we'll go over that in a minute. And that's obvious here when you're given numbers because you can just crunch through the numbers and do a comparison. But what if you get a conceptual question, which anticipate that those are going to be on the exam, and you don't have the benefit of crunching through the numbers and you're trying to think through this? Well, you can try to memorize it. That's one tactic, or try to understand what's happening. So let me explain this a little bit better. Weighted average, I already explained. It's just averaging things out, so cost of goods sold and gross profits is going to be in the middle. What about FIFO and LIFO? Those are the hardest to tackle. So let me explain this. I went back and pulled the cost of goods sold calculations that we did for FIFO and LIFO so we can follow along. Remember, with FIFO, we started out and costed the earliest units. The earliest units, those units we bought first, were at the highest prices if costs are falling. So therefore, cost of goods sold is going to be the highest under FIFO. And if cost of goods sold is the highest, gross profit is going to be the lowest. LIFO went the opposite direction. It said, when I go to cost out units, I'm going to start at the end with the most recent purchase on January the 30th. Since costs are falling, that's going to be the cheapest prices, the lowest prices. So therefore, cost of goods sold is going to be the lowest. And if cost of goods sold is the lowest, gross profit is going to be the highest. If you can think through that pattern, even without not seeing the numbers. Not asking this question, but I also want to point out ending inventory would also follow a consistent pattern. Weighted average, it would be in between because it averages things out. But under falling cost, FIFO would have the lowest ending inventory because what's left is going to be costed at the most recent purchases because it costs out the earliest things first. What's left over is the most recent, and it's at the cheapest prices. Whereas LIFO is going to have the highest value in ending inventory because, again, it goes backwards. It says, hey, I costed out first the cheapest stuff because prices are falling. And so what's left over was the earliest purchases, which happen to be at the highest price. So therefore, the value of ending inventory on the balance sheet is going to be the highest. That's a standard pattern that would follow. Now, I also mentioned your exam questions might not just ask if cost is falling. So keep in mind, even though I don't have the numbers to work out here, if costs were rising, all of this would be opposite, except for weighted average. Weighted average is always going to produce cost of goods sold and gross profit numbers in between. But if costs are rising, let's think through this. Then FIFO is costing out the earliest stuff first, which is at a cheaper price. So cost of goods sold is going to be the lowest, and if cost of goods sold is the lowest, gross profit is going to be the highest. LIFO goes reversed. And again, if costs are rising, it's going to go after our most recent purchases, which if costs are rising are going to be the highest. So cost of goods sold is going to be the highest. And if cost of goods sold is the highest, gross profit is going to be the lowest. Hopefully that helped explain the differences in both cost of goods sold and also gross profit from the different cost flow methods if we have costs that are changing during the period.